This deal looks like a high cash flow winner, but when you actually run it properly, it does not hold up the way people expect. I am continuing the Deal Autopsy series where I take real UK property listings and break them down using our core framework so you can see the difference between something that looks good on paper and something that actually works in reality. This one is a 7 bedroom, 7 bathroom HMO in Kettering, listed at £510,000. It generates around £4,600 per month, which is just over £50,000 per year. And the listing presents this is just over a 10% gross yield and roughly a 9% net yield after costs. Now, straight away, I can see why this attracts attention. On paper, those numbers look strong, and a lot of investors would stop there and assume that this is a solid, high cash flow deal. But this is exactly where people can get caught out, because once you actually break it down properly, the picture changes. Starting with cash flow, this is where the deal looks best at first glance. £55,000 a year sounds attractive, and even the stated costs make the net position look healthy. The problem is that those costs are not the full picture. The listing includes utilities, council tax, internet, and a few other items, but it does not properly account for ongoing maintenance, larger repairs, furniture replacement, lettings costs, compliance updates, or the reality of running a property like this over time. It also assumes the property is self-managed, which is a big factor. The moment you introduce management or even just value your own time properly, the numbers start tightening very quickly. So while the income looks strong, the actual cash flow is far less comfortable than it appears. Moving on to operations. This is where the workload becomes obvious. You are dealing with 7 tenants in one property, which means constant communication, regular turnover, and a higher level of day-to-day involvement. Even if the property is in good condition, this is not passive. You have 7 individual occupants, each with their own expectations, and every time a room turns over, there is work involved, whether that is marketing, viewings, cleaning, or even admin. Over time, that operational load adds up, and it needs to be reflected in how you assess the deal. Looking at risk, there are some positives. The income is spread across multiple tenants, so no one void period does not immediately break the deal, and the property is already set up and compliant. But there is still real exposure here. A deal like this depends on consistent occupancy, stable costs, and smooth management. If turnover increases, if utility costs rise, or if anything operationally slips, your margins can reduce very quickly. There is also the fact that this type of deal is very sensitive to how well it is run. A well-managed HMO can perform well, but a poorly managed one can deteriorate very quickly, both financially and physically. Now, when it comes to exit, this is where I think the deal really weakens. This is not a standard property that appeals to a wide market. You are selling to another investor, and that means your exit is tied to investor demand and yield expectations. If the market shifts or if investors become more cautious, the resale value of this deal can be affected quite quickly because the value is closely linked to the income and the assumptions behind it. So overall, this is not a clean deal. I would class this as an adjust. It is not a bad property, and there are clearly some strengths, but the way it is presented makes it look stronger than it is in reality. The cash flow is not as robust as it seems, the operations are intensive, the risk is higher than it appears at first glance, and the exit is more limited than most people consider. For this to make sense, I would want a stronger margin of safety. That would come from a better purchase price, more conservative assumptions, or a structure that still works comfortably even after proper costs and management have been accounted for. The key lesson here is simple. High cash flow deals are often the most misleading because they focus your attention on income while downplaying everything else that actually determines performance. If you want me to break down a real deal like this for you, I offer core deal audits. There is a form in the description where you can apply, and I will go through your numbers properly and give you a clear view on whether the deal actually works. I will keep breaking down real deals like this, so if you want to understand how to analyse property properly and avoid common mistakes, make sure you are following along.